Dividends are awesome. They make you feel great. You get your check every month. No matter if the stock goes up or down, you get your check. I like dividends, but I want to remember that dividends aren't always the best thing for a company. Companies will pay dividends to attract investors. Think about it. If you're a company and your stock is lagging and it starts to suck, but you give a 4% dividend yield suddenly, when the S&P is doing 1.4%, it's going to look very attractive. That's what drives up all of the prices we've had recently. When the banks were giving 0% and the S&P at that time was doing 2.5% dividend yield, people said, hey, I might as well invest in the S&P. I'll at least get 2.5%. They can't take that dividend yield away, but they can. Remember, guys, dividends are paid after the company's already paid its taxes, and then you're taxed again. It is double taxation. Not only that, dividends can only be paid out of cash flow. And cash flow, a lot of companies will sit there and borrow money if they don't have the cash flow to pay the dividends just to get people in to buy the stock. So if you want to know if your dividend yield is supported by the company and can continue on, watch our videos. Watch more of our videos. Learn more about how we look at free cash flow, the lifeblood of the business that can be used to buy dividends. But it is double taxation. I don't care what anybody says. When I hear these politicians argue about, oh, the dividend tax is too low, it's already been taxed at the corporate tax rate, and then again when it hits your account. So it is not tax efficient. The company is better off, in a lot of cases, buying back shares or paying down debt. That is a better way to use the capital, but they know people love their dividends. Keep in mind, I like getting dividends. So a very common question we get is, hey, should I just invest in a high dividend ETF versus the market ETF? Potentially. There are some dividends. So this one, SCHD, VYM. So let's look at the actual components of each of these two, SCHD and VYM, to see a little comparison. So here are SCHD's top holdings. Merck, Pfizer, Amgen, Coca-Cola, Pepsi, IBM, Texas. Guys, these are all big companies. This is why in the last 10 years, these have not done as well. Why? Because the last 10 years have been driven by Amazon, Apple, Tesla. All these big companies have driven the S&P to new heights. All these crazy, crazy companies have done that. These are the boring ones, okay? I once heard a stat, to be verified, that if you went back to 1928 to now, if you bought only companies that had dividends, you outperformed the market by 2 or 3 percentage points. That's a big number. I've not verified that, but that's a big number. Here, the biggest company here is Merck. It's 4.6% of the entire stock portfolio. This is only the top 15 or 20 holdings. They're very concentrated. They're big, boring companies. What companies pay dividends? Big, boring companies. Let's go look at VYM. VYM is very similar. Johnson & Johnson, Procter & Gamble, ExxonMobil, JP Morgan, Home Depot, Chevron, Pfizer, AbbVie, Bank of America. Boring, big companies. Guess what? I like boring. Boring tends to be overlooked, tends to sell for cheaper. Those dividend yields are going to keep growing because guess what? You better believe these guys want to be known as people who cut dividends. Dividend cutting is not a good thing in the market. There's actually dividend aristocrats, the ones that keep increasing their dividends consistently over decades. Those are the companies people love. They want that reliable check, especially in retirement. I want that check. And that's why these companies pay this. They want to make sure they have their fundamental investors who believe in them and don't sell their stock because they can rely on that dividend. The S&P does 1.4% dividend yield. These two have very low expense ratios. Both have 0.06%. That means every $1,000 you give them, they're only taking out 60 cents of that money for expenses. That's pretty low. 2.87, 2.77%. Almost double on this one even, pretty much double than the S&P. But again, go make sure that a lot of high dividend companies in these portfolios are not dividend traps. So what's a dividend trap? A dividend trap is a company's dividend that they're paying that they can't really afford. Let's go pull up 8-pillar analysis to show some examples here. So let's look at Merck. So Merck is currently paying $6.7 billion in dividends. Can they afford it? Sure. Their 5-year average free cash flow. There's a reason why we put the data right above dividends. We want to make sure that we can compare it. $8.44 billion. That's a big chunk of their last 5 years. Now, granted, last year they did $12.7 billion. But you got to make sure that the company, especially in pharmaceuticals, can support that going forward. What's in their pipeline? What's coming off of their list of drugs that are going generic? If they get a big chunk of their revenue gone, you better kiss goodbye to this dividend. Absolutely. Look at a company like Intel. Intel already announced that they were going to cut their dividend because they're like, listen, we're reinvesting back in the company big time. That's fine. I was cool with that because I liked the reason why they cut their dividend, but you better believe it made people mad. Absolutely is going to do that. Look at AT&T. AT&T did the same thing. AT&T cut their dividend, but their argument was, hey, we were 8, 9%, now we're 4%, we're still really good. But people didn't like it, and the stock fell from there. So people love the dividend, but the most important thing for you is make sure that the dividend is easily covered by cash flow. How much? I think the free cash flow over the last 5 years should be double what their annual dividend payment is at least. That way you go, hey, listen, this isn't going away. Let's look at a company like Apple. It's adorable with Apple. Apple's dividend is 0.6%, pays out about $15 billion a year. Their last 5-year average was $75 billion a year in free cash flow. That was 20% of their free cash flow paid out in dividends. And last year they did $105 billion. It was less than 15% of their free cash flow. They can afford their dividends. FYI, big waste of money. Absolute waste of money. What do I care about 0.6%? Pay down debt. Buy back shares. Especially if it's an undervalued company, actually only if it's an undervalued company, buy back the shares. There's no taxable event there. So I'm going to get taxed on this money versus buying back shares gives me a bigger and bigger piece of the company and not being taxed on that until I sell the stock much further down the road. Let's be smart and look at these companies. Now, there are companies that are just so big, like AT&T, the growth potential isn't huge. Okay, if the stock is selling for high values, pay out a dividend. If the stock's selling for low, buy back shares. If you're part of our community, you can go into our Everything Money community, go to the chats. We have a dividend chat right here, dividend stocks, and engage in people every single day to talk about dividends. If you're not part of our community, everythingmoney.com, Patreon, go sign up. You can talk about dividends and other topics all together with 6,000 people. Don't just get stuck in obsessing over a dividend yield as much as you might love it. But if you want to go find good dividend yields, just make sure that they're absolutely able to handle it using their free cash flow.